this is the presentation and analysis of your long-term liabilities, and we're looking at the long-term liabilities section of the balance sheet. And if you've got your bonds payable that were issued at face value, they would simply be on the books at bonds payable, and that would be sort of the end of the story. You would say that they were 10% bonds, and they would be due in, if they were due in 2025, you'd communicate that. And so that would be if they were issued at face value. Say we had $1 million bonds, that would be your long-term liability. But if your bonds were issued at a premium or a discount, and they have unamortized premium or discount, in other words, there's still some that's on the books, your bonds payable are going to be reported as bonds payable. You'd tell all this about it, but less any discount on bonds payable. Okay, so say if your discount on bonds payable is $4,000, that would be less that, and the bonds would be reported at $996, which would be their carrying value or book value. Similarly, if you had the same bonds payable, but there was a premium of bonds payable, in that case, they would be on the books at bonds payable, 10% due in 2025, but then it would be plus any unamortized premium on bonds payable. Okay, and so say we had a premium of the $2,000, the carrying value of those bonds would be 1,002,000. Okay. Okay, so that's would be your bonds payable. They're either less discount or plus amortized premium. Mortgages payable, you'd have a lot of note disclosure when you get to the disclosure of all of these in the notes to the financial statements. It's pretty extensive, but you'd want to say the interest rate on the mortgage, when it was due. Okay, so if it's due in 2018, you'd put that down. And if it's secured, you would say secured by whatever it was secured by. Okay, and that would be, then you'd have your total for your long-term liabilities section. Okay, so that's the presentation. As you go on in accounting, you get a lot more detail on the notes. The liabilities have extensive note requirements, disclosure requirements. Okay, debt to total assets, this is simply analyzing. So you take your total liabilities and you're dividing by your total assets. Okay, so and that's total current and long-term liabilities. Total liabilities, total liabilities. So company A has total liabilities of 1,000 and total assets of 2,000. So when you divide that out, you get 0.5. Okay, that's your debt to total assets ratio. Okay, so if you look at company B, and they've got 1,000 in total liabilities and 4,000 in total assets, you have to ask yourself, so their debt to total assets is 25%, which company do you like better? Do you like the one that has 25 or 50? Generally you think, oh, bigger numbers are better, but not in this case, because if you have a bigger number up here, it means that you've got more liabilities and so more risk. If you think about your, if say you had personal assets of, $3,000 and you had total liabilities due of $2,700, you're in a fairly risky situation. Where if you had the same 5,000 or 3,000 in total assets and you only owed $200, you'd be in a little better situation. Debt to total assets really measures the risk associated with the company. You could look at company C, who has 4,000 in liabilities and 1,000 in assets. They've got a really nice big ratio of 4. Do you like those guys? No, this one is at huge risk. It's got all these liabilities and only this amount of assets to cover them. So when you're doing any of these ratios, you sort of, compare them to other companies in the same industry and your company over time. But to just do a few things like this, it helps you understand what's going on with the ratios. The next one they talk about is the times interest earned. And this is just really when creditors are looking to lend to you and investors are looking to invest in a company. They want to know, okay, so can you cover the interest payments that are going to be due on some of your long-term liabilities? So times interest earns, you take your net income and you add back your interest expense. And on the exam, a lot of times students will add back interest revenue, which doesn't make any sense at all. It's the expense you're adding back. And you add back income tax expense. So on the top part of it, you're doing all that, and then you divide it all by your interest expense. Okay. So if you had company A and it had income of 10,000, you'd go, okay, so they get income of 10,000 net income, plus their interest expense is 1,000, you'd add that back, plus their income tax expense is 2,000. That would give you your top number, okay, and then you would divide it by, this is your interest expense here, of 1,000, okay? So you would end up with basically, that equals 13,000 over 1,000, and so it is 13 times. That just says they have the ability to pay their interest obligations 13 times, okay? A higher ratio in this case means a greater ability to pay off their interest obligations. And when this number here is what's called earnings before interest and taxes, or EBIT. You'll see that in the some of the financial press, earnings before interest and taxes. So you compare this with, let's just go right to company C, who has 10,000 in income, plus they've got 8,000 in interest expense. That's a lot more interest expense, and they've got the 2,000 in taxes, and if you divide that by 8,000, you end up with, so like 20,000 divided by 8,000 equals 2.5. They've only, 2.5 is their times interest earned. So this company has a lot better ability to keep track of, keep current with their interest payments. Okay, so that's about it for presentation and analysis.